Hey YouTube, this is Leo with DRIPCalc, and in this video I want to talk about selling covered call options on my dividend stocks and the way I do it to increase my dividend yield and my overall returns. So first, please smash the like button and subscribe to the channel. If you have any questions or comments, put them in the comment section below. And finally, guys, I am not a financial advisor and this video is not a financial advice. Please do not copy my methods. They are for informational purposes only, and investing involves risk of losing capital, and I don't want to be the one who caused it. So this is for informational purposes only. And one more thing, so if you want to try out this visual stock research software that I'm using for this video, this is a stock comparison tool, and we have individual stock research with all the visual metrics easily accessible, and you can compare all the important metrics like revenue, EPS, free cash flow, dividends, and all that good jazz. We are offering, just for the viewers of this video, we're offering a 30% lifetime discount. And if you want to try the software for free, we offer a 2-week free trial. If you like it, continue using it. If not, you can cancel. But only for viewers of this video, 30% lifetime discount. And we're basically, this is one of the last times we will offer such a high discount. And even if we raise the price in the future, or when we raise down the line, your price will remain the same, and you will get the benefit of using the software. Thousands of stocks in our database, and you can compare and compare side by side different stocks and research. So again, at the end of this video, I'll put on screen the discount code for 30% lifetime discount. With that, let's begin. Here's the reason why I'm making this video. Basically, a few months ago, I posted on Reddit that, and this was about Bito. Now, I will use Bito in this video as an example, but for the most part, I will be talking about ExxonMobil and selling covered calls on Exxon. But basically, I was talking about YBIT, which is a covered call ETF, and the underlying stock for that is Bito, which is a Bitcoin futures income ETF. And basically, my point was that why would you invest in Bito in YBIT, if you can invest in Bito, collect the dividends, and sell your own covered calls? And basically, I'm not going to read the whole conversation, but the few comments over here, they just kind of made me a little bit depressed, if you may. Basically, people don't want to put 5 minutes of effort to increase their dividends or their income by almost double, or in some cases more than double, and they would rather pay some other people to do it for them. And if you watched my other videos about YieldMax, I don't think those managers are doing a good job. This video is now not about YieldMax, but basically these comments. This guy says I don't want to, meaning don't want to sell cover calls. That's why I pay people to do it for me. I like people to shovel the snow off my walk, driveway, or whatever. And then this comment is kind of out of order. It doesn't really make sense because he's talking about dividend ETFs. But this last comment just kind of like killed me. It was like, you people insist on making more money. It was like, okay, if you don't want to make more money, okay, it's your business. But if you guys want to make more money, you should watch this video, and again, smash the like button. It really helps with the YouTube algorithm to promote this videos, helps my channel grow, and it's a young channel, so everything helps. Anyway, there was also a comment on Twitter, and one of the guys I follow, one of the dividend guys, he was basically talking about covered call options. I can't find that comment right now. Maybe he deleted it, but whatever. So anyway, let's take a look at the big picture. So here is my cost basis for ExxonMobil stock that I have had since I began buying it in February of 2021. So about 3.5 years by now. And in that time, I have collected $13.45 per share in dividends. Okay, and at the same time, I have collected $17.81 per share in covered call premiums, and that gives me an extra income of 32.5% of covered calls versus dividends. Now I collected both, but the covered calls brought me 32.5% more than just the dividends, and I think it's an amazing achievement. Could be better, of course. Now I'll show you that one of my positions I kind of got overzealous on it, and now I'm trying to get out of it. But essentially, with covered calls, even if you get in the money, you can perpetually roll your position, keeping your shares, collecting the dividends, and collecting a little bit more in covered call premiums, and effectively get out of it at some point. But that will be toward the end of the video. But basically, going back to this is my cost basis, and actually I'll show you that my real cost basis is much lower. It's about $55-60. But what happened is I got assigned on one of my calls, and what I did is, because I was forced to sell my shares, I think it was at around $105 or $110. I bought those back for about the same price, and that increased my cost basis. Okay, but still, current price is 112. I'm sitting at 72, and that's a $40 difference in my favor. So that's a huge, more than 50% gain. Now this is still a paper gain, but my net cost, if we include whatever capital gains I made from that assignment and my dividends and my covered call premiums, my net cost per share is $31.80, give or take, and that puts me at a yield on cost of 12.5%. Actually, a little less because I projected higher dividend payment. So at 95%, which is the current dividend amount, my yield on cost is almost 12%. Whereas if you buy the shares today, your dividend yield is 3.37%, which I think is kind of low. And also, ExxonMobil, it does not have a good track record of dividend growth. So I wouldn't be buying this stock today at the current valuations, and I'll show you why just in a little bit. But basically, the point is that my covered call strategy brought me a lot more money, 32% more money than the dividends alone. Okay, so let's switch to over here. We're done with this comment. Anyway, so just quickly we'll show you. This is the beginning of my ExxonMobil history. First time I tried to buy it was a couple months after COVID started. So in July of 2020, I tried to buy it for $43. It was a limit order, and it didn't get filled. It got canceled. I don't know why I didn't just like buy it anyway at the market price, but I didn't. And so the first time I bought was February of 2021 for $49, essentially $50. And then I immediately sold the covered call for $1.16, and the strike price was about 15% higher, and 57.5, and it was 3 months away. So I think it's a pretty nice premium and much higher strike price. So I was never assigned on those expired. Then a couple weeks later I bought more for $52, and then again I bought more for $52 on the same day, and then a couple days later I sold another covered call, now with a $65 strike price. Now the shares were 52, I sold a $65 call, 4 months out, collected another $272, and so on and so forth. So basically this just shows that my actual cost basis is in the $50 range, under $60, but because of the assignment and buying back the shares at higher price, my net cost increased. Now here's what you can do with covered calls. Okay, basically I feel like it is a safe bet that ExxonMobil will not be above above $120 within next say 12 months. Okay, and so what I would do is I would sell a $120 call. That gives you about $7.50 buffer from the current price, and then another $7.33 premium that you collect by agreeing to sell your shares for $120 are on or before August 15th of next year. So that's a little bit less than a year out, about 11 months and 10 days, 11 months call it, and you're collecting almost $15 in premium if you are assigned on that position. So let's do a quick calculations. So 120 minus 112.44, that's the last price of ExxonMobil, and plus 7.33, that's what you would likely get if you sold this cover call. So if you were assigned, you would collect an extra almost $15 versus the price of ExxonMobil today, plus you add about $4 of dividends during this time, maybe 3 payments of dividends, because the X date, at least last X date, was exactly on August 15th. So likely if you're assigned on the shares, you may not qualify for the dividends. Now I would change this to September, but for some reason it comes up empty. So the next one that we can go to is December of 2025, and that puts us at like 15 months away. But again, you can sell a covered call $120 strike for $8.88. That's another $1.50. Now you collect, for sure, you collect 4 dividend payments during the same time, and so we subtract 7.33, we add 8.88, and we add about $4 in dividends that you collect during this time. So that puts you at $20 of total total income or gain that you get by selling this covered call if you get assigned. Okay, so we divide this by 112.44, and that gives you an 18% return over the next 15 months. You know, the average S&P 500 return over the last 24 years is 7.38% per year, including dividends reinvested, and 6.14% per year without dividends reinvested, just collecting the dividends. That's a S&P 500 return. Now, I'll show you why I use this number, basically because this is almost the peak of dot-com bubble, and for the next 11 some years, you basically went nowhere on S&P 500. So if we go 30 years here, then your average return per year is 9%, and with dividends reinvested, it's 10.34% per year. Okay, and again, you would be collecting in 15 months 18%. So I think it's better than average S&P 500 return, and nothing to be ashamed of. I think it's a great return. But the better part is, let's go back to the options chain. So even if you are in danger of getting assigned, what you can do is you can roll your option. So first of all, you can actually sell a $125 call, and with that strike price, there's almost no chance of being assigned. But even if you are in danger of being assigned like a month or two before the expiration of this option, you can always roll it. So I'll just show you an example. Let's say we have an open call for September 20th. Okay, so that's 12 days away. And let's say we are at $115. Let's say we sold the call for $115, expiring in on September 20th. So what you can do is you can buy this back for $1.20 right now. You probably collected more than that, so that already gives you an income. And then you can go ahead and sell a December 2025. So extended by a year and 3 months, so 15 months, and you would collect. If you sold another $15 call, you would be basically getting $10.50 premium right away. If you increase your strike price to 120, you would be getting, so 888 minus $1.20, that's $7.60 premium for you to agree to sell your shares 5% for $5 more, and basically at $120, 15 months away from now. And back to this spreadsheet thing, by doing this, I have collected in 3.5 years, almost $18 per share in covered call premium. So I think it's a really good strategy, and you keep collecting dividends because you still own the shares now. These contracts, you have to own 100 shares to sell a covered call, because each contract is for 100 shares. But even if you're in danger of getting assigned, you can always roll your position and almost perpetually keep your shares, collect the dividends, and collect the premiums. And here's the example. I think it's a very good example, because here are the basically position I have. I sold this somewhere over here. Let me show you the price chart for ExxonMobil. So I sold that somewhere over here in the summer of 2021. So, and I sold an $80 call expiring in January 2024. So like 2 years away, more than 2 years away. I collected $3 premium for that call, and there was nothing, and the difference was like almost 30% up, you know. But then the share price of Exxon just ran away from me, so that was a dumb move on my part. If I held a few months, I could sell a much higher strike price call and collect a lot more premium on it, or if I sold a shorter duration, I would collect. But and in this video, I am saying sell a leap, sell a long dated call, and in many situations, it's probably not a smart idea. If, for example, a stock, it's a growth stock, and there is a good chance it will run, so then you're kind of leaving money on the table. But going back to this example, so this was expiring in the beginning of this year, 2024, and I didn't want to get assigned. I was deep underwater, so the share price was about $107, and what I did in August, so here is my roll, sorry, not August, October of last year, end of October, what I did is I bought back the share. So this is a roll. It's 2 transactions in one. I bought back the option for $28, and I sold another option 2 years out for $30.30, and I collected $2.30 right here per share in premium. So what that did is effectively it extended my ownership of those shares. It increased my strike price from $80 to 85. So I will, even if I get assigned, I will collect an extra $1,500 because this is 3 contracts times $5. And I already collected $2.30. Yes, it ran away from me and it's not ideal, but effectively I am still keeping my shares. I'm still collecting dividends and I'm protecting them with a covered call that is in the money, but I am reducing that in the money part. I reduced it by $5, and hopefully within 2-3 years I will be able to catch to the price of ExxonMobil, because I think it will actually go down and I will be able to get out of this contract. But even if I'm not, a year from now I will be able to roll this again. The premium will be much lower, and I'll be able to collect another $2-3 and increase this from 85 to 90, and eventually I'll get out of this gem. But you don't always have to get into the gem. So let me talk about why in this particular case I feel like it's safe to use, if you already own shares of ExxonMobil, why I think they're safe stock to do covered calls. So here I have a chart of ExxonMobil share price versus crude oil. So this is WTI, West Texas Intermediate, and you can see it in this chart. So my data for WTI crude goes back to 2000, to the year 2000, so only 24 years of data, and so they're starting on the same date. And you can see for the most part, especially over here in the first like 7-8 years of this chart, the price of crude was trading basically in line with the price of ExxonMobil shares. And then during the end of Bush era, the prices just skyrocketed to $140, whereas the ExxonMobil didn't follow them. And then as soon as the election happened and price of, basically recession started, the price of crude collapsed to like $37, and then slowly ExxonMobil started going down. Then they kind of converged again. So this part, they kind of stayed together with except for the small, well, actually large jumps, but short-lived jumps. They converge again and they stay together until 2014, at which point the price of crude significantly dropped, whereas the price of ExxonMobil slowly kind of followed it down a little bit all the way into COVID, where they converge again. They meet each other very closely over here. So 61 versus $70. And then there's a huge drop, market volatility, boom, boom, boom. Here they converge coming out of COVID, at least the initial stage of COVID. They converge again and they follow each other all the way until like August of 2022. At which point Exxon continues to grow and crude starts going down. And today, or last close, was $68. Okay, and somewhere over here, Biden released the strategic petroleum reserves that drove the price of oil. Well, that was a major factor in the beginning of collapse in oil prices, because here they were like at $120. The inflation peaks at 9.1%, at least the official inflation. Price of oil starts going down, but what happens is ExxonMobil price continues to stay at elevated levels. And now if we scroll down over here, this dividend payout ratio, it's pretty safe for ExxonMobil. Here's the free cash flow to dividend. It's not looking so great, but that's a whole different conversation. Basically, here I'm trying to explain why I think that ExxonMobil is safe to sell long-dated call options on. It's because I don't think it will be running up at this point. I think it will be going down, just like we've seen over here. The price of ExxonMobil going down following huge drop in the oil prices, but doing so ever so slowly. But eventually they converge, and I think we will have the same thing over the next couple of years. I think they will meet again, and I think this meeting will happen by prices of ExxonMobil going down rather than oil going up, at least in the next couple of years, because I think there will be recession. Anyway, so if we look at revenues for ExxonMobil, here's a very good chart. We look at 10-year revenue. We're right now sitting on the same revenues as we had 10 years ago, and roughly the same net income. So while the price of ExxonMobil went up 15%, revenues kind of did not. And this includes actually the acquisition of Pioneer Resources, PXD. If they didn't merge over here, this revenue would be lower. It would be below 80 billion, I think. That's my belief. I didn't read the report. I don't think they kind of disclose the contribution of Pioneer into this pile, but it's not looking good. Their debt went up, cash went down. Their EPS over this period is basically almost the same. It went up a little bit by like 22 cents, which is like 15%, 15-20%. No, it's like 10% difference between 10 years ago. So here we have a lot of money. They were printing money over here because like the prices of oil were high. But now I think it's going down, and EBITDA is going down, free cash flow is going down, free cash flow per share, obviously. CapEx is expanding. Well, actually, no. From 10 years ago, it's actually shrinking. Dividends are rising, so they have higher expenses. Their dividends are up significantly since then. Also, what I don't like about ExxonMobil is their dividend growth. In the last 10 years, it's only 3.25%. Yes, last year was like 4.4, but how sustainable that is, I don't know. They've been buying back shares until this acquisition of Pioneer Resources, and now it went up. Hopefully, they will be buying back shares, but you can see the overall number of shares went up in the last 10 years. Here, the interesting chart is revenue estimates, and you can see it. The Wall Street analysts project the revenues to be going down all the way into Q1 of 2027. However, at the same time, they're projecting EPS to go up, which is kind of counterproductive or counterintuitive. One is going down, the other one is going up. That's weird. So net income. Also, it depends on the number of outstanding shares, but they estimate the EBITDA to go down. So that's weird. But anyway, so their net profit margins are down from 2022. Now, if we look at the longer duration, they're kind of up over the average, but compared to the last couple of years, 2 years ago, they're down. Same with gross profit margin, same with PE. So the PE is really up, and I think it's kind of expensive for an oil company. Well, over here, if you would take this 5 years, then it's actually on the cheaper side, but I think it was overpriced back then also. Price to sales is up, return on capital employed is down, return on capital invested is down, and basically, we don't know what's going to happen. We might be in a commodity super cycle long term, but I think in the near term, and we can see that from the price of oil, like we have, the global consumption, the tankers that have to go around Africa right now because of the Red Sea crisis, they're consuming about, they're taking away 1 million of barrels per day because they have to go around Africa. The tankers, the container ships, all that sea traffic that cannot use Suez Canal right now, they're contributing 1 million barrels per day extra to the global demand. Okay, and at the same time, there's like oil production cuts in Libya, and OPEC wants to reduce the oil output, and with all of that, the oil is still trading at $68. And if we look at price chart, let's take a look at price chart of oil. This is very interesting over here in COVID, we're in a negative territory for a brief moment. But anyway, like if we look at 1 year chart, we're down significantly, guys. Like a year ago, we're $88, $89, and now we're $68. So we're down $20 in 1 year. And even with all those constraints on the production and increase in demand, at least on the shipping side, on the sea shipping, the oil prices are down. This is nearly the lowest price point of the year. It was actually below $68, probably the low 52-week low. Let's see over here. Yeah, so this was a 52-week low just recently, and so I don't think we will be seeing higher oil prices in the near term, and therefore I think ExxonMobil price will be traveling toward the convergence with the oil price, but the trend will be down in the near term. That's my position, and that's why I am comfortable selling covered calls on my shares, long dated. And again, even if they run away from me, I can always roll them indefinitely and keep collecting, albeit smaller call premiums, but still keep my dividends, still keep my shares, and avoiding tax event. Now, I am not teaching you how to do all of that. This is just for informational purposes only. This is not financial advice, but and the rolling part, I think that it deserves a whole different video because it's a pretty big topic, when to roll and at what strike, what distance in time and whatever. But I am able to protect my shares by rolling them, rolling the in-the-money contracts. And I think soon enough I will be able to get out of this jam. And going back to this chart, this already includes the latest dividend payment of 95 cents that will be happening in a couple of days. However, in 4 months, I will be able to roll my contracts expiring in January of 2025, so that's 4 months away, and this will increase by another, I don't know, $4 or $5 per share. I will once again sell a year out strike, and I think we'll boost this to $25 per share. I think I will be able to collect about $5-6 per share in the premiums and maintain my $120 strike level, and I think we will not be able to hit that. Now, this doesn't always work with all the stocks. So here's the options chain for Meta, and let's quickly look at Meta stock. Let's say you bought Facebook somewhere over here for $300, and then you sold a year out call for like $350. Okay, so this is July of 2023, and here's July of 2024. The Meta really ran away. It went up 80% from this price, and those covered calls you would not be able to defend. I mean, you can roll them indefinitely, but it's highly unlikely that Meta will be in the $300 range anytime soon. So it would take like 10 years to basically catch up to that price if you ever able to. But the Meta is high growth stock. They have amazing ratios. They have amazing revenue growth, like over here. 1 year growth 22%, 10-year growth 30%, and EPS growth is even more amazing, 73%. So it's a high growth company. So selling long dated calls on stocks like Meta is kind of dangerous in terms of like it will most likely run away from you, and therefore I'm not advocating. But stocks like ExxonMobil, they have low beta, and it's unlikely they will run away from you. So at least for me, I feel comfortable doing that, and I realize great returns from selling covered calls. And so stocks like that move slow, like Coca-Cola, for example, also another slow moving stock, especially right now, it's like at all-time highs. Let's look at Coca-Cola chart. So yeah, look at that, it's near all-time highs. Here's the 10-year price chart. And so on this stock, I would actually feel comfortable selling a long-dated call, because I think this run-up, it was a defensive move after August 5th. We had a massive drawdown in the tech stocks, and it's a defensive move, but I don't think it will continue running at this rate as it did right now. And so if we look at options chain on Coca-Cola, so here we have January of 2026, so 14 months away or 16 months away from now, I would probably sell an $80 call on this. I don't really think it will hit $80, and if you feel like it will, if you want to be more safe, you can sell $85 call and collect $1.42 right now. So that is actually in line with their dividends. So let's look at their dividends. So a little bit less than the dividend. So you collect almost $2 a year in dividends, and with the option you will collect about 75% of their dividend. But again, you're very safe on the share price. Again, I'm thinking that this run up from 63 in July to 72, 73 in August, I think it's unwarranted, and I don't think it's sustainable. I think we'll have a drawdown, and at least in my opinion, I don't think Coca-Cola is going to $85 in 16 months. And so I would be, if it was me, if I had shares of Coca-Cola, I do not, but I would be selling an $80 call. And again, if you're in danger of getting assigned, usually you can roll it for another year or so, and in some cases even maybe increase your strike price, collect a little bit more premium. Now, because for some reason they don't have an 82.5, I think in a year they will, because right now here the stepping is like $2.50, and then after 80 it goes to $5 between the strikes. But I think as we get closer and the price is closer, I think it will allow you to have a more narrow. But anyway, if you feel ultra defensive, you can essentially collect 75% of your future dividend, and a really nice almost 20% up from current price strike. So even if you get assigned, you collect 20%, almost 20% on the share price, and another few percentage points on the covered call premium. So if I had, for example, many, like 1,000 shares of this, I would sell maybe 5 contracts at 80 and 5 contracts at 85, just to protect myself a little bit. And so I would have an easier time of rolling this in the future if I have to protect those shares, if I want to. Like, you can actually choose to get assigned. Now, for me, I don't like getting assigned because it's a taxable event. If it's above my cost basis, then I have to pay taxes on it. So something I don't like doing. If it's below, then you lose money. You secure like a capital loss, short or long term, doesn't matter. It's still a taxable event that you have to deal with. So I don't like doing that. Therefore, if I was super defensive, I would sell an $85 call. Otherwise, I would sell an $80 call. Now, another quick thing, we're almost done, but basically because we started this video with BITO and YBIT, And I just made a video that I'm basically not investing in YieldMax anymore. I'm not selling my shares, I'm not selling my position, but what I'm doing is I'm diverting all my dividends from YieldMax into BITO, which was the topic of this post on Reddit. And basically here is BITO options chain, and I already preloaded, and the closing price was 16.80. So what you can do is sell 16 months out, so that's January of 2026, $20 call. So that's already an almost 20%, actually more than 20% premium on the stock price alone. And then you're collecting almost $3 on the call premium. So effectively your break even is 22.85, give or take. And you can see there's a pretty decent volume and pretty decent open interest. And yes, the bid ask spread is kind of wide, but I think for 280 you can sell it. So let's take a look at our nifty calculator here. So what we do is 2280 divided by current price 16.28. So that's a 40% premium that you make if you get assigned in 16 months. You collect $3 of that, almost 20% upfront, and your total return in 16 months would be 40%, and that is before dividends. So that was the point of my post over here on Reddit, is that not only you collect really decent dividend yield with BITO, you also can sell your own covered calls on it. And with this, you secure 285 per share right now, which is almost 20% of the share price. So we can do the calculation. 28 divided by 16.28. That is 17.2% premium that you collect upfront right away. Okay, and then even if you're assigned, your total return would be 40% plus the dividends you collect during that 16 months. And while I do think that dividends on BITO will be going down in the near future unless we resume the Bitcoin bull run. So latest dividend is $1.20. Okay, we have to scroll down because it hasn't been paid. So this chart right here with the dividend amount and dividend yield curve, this accounts the curve part, the dividend yield. It needs a closing price of the shares on the day of the payment. Okay, so that's why we don't have the September payment here yet, because it hasn't happened. That will be in 2 days. On September 10th, we'll have a closing price and we'll have a dividend payout. But if we scroll over here, this is just all dividends, and we already can see $1.21. This is the dividend that will be paid on September 10th. And the X date was September 3rd. So if you buy the shares now, you will not collect September dividend. So going back to this chart, I think next dividend will be like maybe $1, maybe 80 cents. And I think for a while it will be dropping to probably will bottom out at like 30 to 50 cent range until we have the next leg of our Bitcoin bull run, and that's when it's going to start going higher. But even at 50 cents, okay, let's do the calculation. So if you sell a cover call right now, so that's 16.28 minus 280, which you can actually collect pretty easily right now. Your net cost is $13.50. Okay, so let's say for the next year the dividend will be like 40 cents. Okay, so 12 times 0.4 divided by 13.5, you're getting a 35.5% yield. I think it's pretty good yield if you ask me. And likely we'll collect more. I don't think the Bitcoin bull run is over, but the worst case scenario will probably over the next year average dividend will be like 30-35 cents, maybe 40, maybe 45, but it's still $1.20. And the next one I think will be about 90 cents, maybe $1. But anyway, this video is not about BITO. I'm just saying that you can, and I think this is what I will be doing. I will be selling a $20 long dated call on BITO, not on my main position, but basically on whatever I'm buying with YieldMax dividends right now. I will increase my returns by selling long dated cover calls. And if I'm not assigned, okay, if I am assigned, I'm getting a 40% return plus the dividends I collect. And if it goes to $20, that means actually the dividends are also higher than 35 cents. I would say that if it goes to $20 by the end of the next year, then likely the dividends will be like 75 cents per month. So 0.75 times 12 and divided by 13.5, it's a 66-67% yield. So yeah, covered call options are great. Not on the growth stocks. I will not sell long dated covered calls on growth stocks, but definitely on slow growing like Coca-Cola, like ExxonMobil, other oil stocks, but especially ExxonMobil, because I think it's way overpriced now. If we compare Exxon to Chevron, Chevron has really taken a beating. It's really down from its highs recently. So let's take a look at the share price, and right here, so Chevron was 188 a couple years ago, and now it's 138. So it's down 50 bucks, whereas ExxonMobil kind of stayed flat. So part of that is because Chevron, they have a deal to buy Hess, which is in limbo, and it's being blocked by ExxonMobil because they are a partner, majority partner in the Guyana oil project, and they don't want Chevron to get in on that project. So that's why we have kind of going down share price of Chevron. But for me, I actually like Chevron more than ExxonMobil at this point. I think it's more representative of the reality of the oil market. So if we compare prices of Chevron to crude oil, let's take a look at the price. Oh wow, they diverged a long time ago, and Chevron kind of ran away from the oil and stayed above it. So interesting. I need to to think more about this, why this happened. So 10 years ago they diverged, and kind of until like over here a little bit they kind of almost met in March. So this is when Jerome Powell started raising the interest rates, but since then the divergence increased. Yeah, I need to take a deeper look at their earnings and all of that good stuff to basically tell you what I think about that. But at this point I don't like the price right now. So, and I think that premiums on ExxonMobil, I mean on Chevron, are not so good compared to Exxon, especially relative to my net cost. But if you buy it today, let me see. All right, so if you were to sell January 2026 covered call for $160 strike, I think it's kind of in danger because Chevron just dipped a lot, and by then the situation with a Hess purchase will be resolved, hopefully in the favor of Chevron, because I own shares in both Chevron and Exxon. Now my Chevron position is much smaller than Exxon, and I did sell cover calls on it, but not as successfully as Exxon. At this point I would not be selling cover calls this far out, because I don't think because the price of Chevron really dipped down. I'm still not ready to buy it because my cost on Chevron is like $70, so it's 50% above my, no, 100% above my net cost. But it dipped from 180, 170, 180 to like 138. I think I'm not liking this. I wouldn't be selling it right now. I would be selling a short dated. If I was to sell, I would sell something like a month out, 33 days. Yeah, probably 150, kind of safe-ish. You only collect $54 in 1 month. That's about covers their dividend. So if you go 3 months times that, it's about equal to their dividend amount. Still kind of alright, but I don't like that it dropped so much. Anyway, so yeah, bottom line, selling covered calls on slow moving stocks, I think it's a great way to increase your returns, to increase your cash flow, and it's working. And even if you get caught in a jam, you can always roll up and out. And actually with Chevron I got caught. I made a video about 6 months ago, and I will link it in the description, where I sold the call for $170 and it ran away from me. No, I sold a $165 call for January, no, for May 17 of 24. Let's take a look. CVX. And it ran away from me. I had to roll it, and I rolled it. I collected more premium, then I bought it back. So yeah, look over here. So May, I rolled it over here in April when I was getting really close. It was already above my strike price. So I rolled it to $170 expiring in January, and I think over here I bought it back for pennies on the dollar. And basically I don't have a position. I only had one contract. But even with that, I'm still making a decent return with covered calls. I just don't like the current price. When the price of shares is down, it's not the time to sell covered calls. You probably want to do it when the share price is up. This way you can secure more premium and higher strike price. So yeah, on a down day, I would not be selling covered calls. Anyway, guys, I know it's another one of those long videos, but hopefully it's educational. Hopefully it helps your investment strategy. Once again, this is all for information purposes only. Do not follow me into this, just like you can think on it, but I'm not giving you advice to do this or to not do this. And caution retail, and you can actually see TJ the Wheel deal, how he got stuck with XOM, not with XOM, with Meta. He owned it at like $100, and he had to get rid of it at 200, and now it's and he lost like over $1 million, not lost, but missed on the profit of over $1 million just because there was like 4,000 shares at play with and the differential is like $300, so you can easily do that. 4,000 shares times $300, and he actually talked about it in one of their latest videos. So that's $1.2 million that he missed on because he sold aggressive covered calls on Meta, and Meta is a very high growth stock, and it could pop to like $600 and put you underwater on those calls. So I won't be selling long dated calls on high growth stocks. And in the next video I'll show you my covered call strategy on Palantir, which is a high growth stock, and the good news, it was just accepted into S&P 500, so the shares are already up 10% in after hours. I think it will open up another 5% on Monday, and I'll show you my covered call strategy on Palantir in the next video. Thank you for watching, guys. Not financial advice. Smash the like button, subscribe to the channel. If you made it to this far in the video, I will give you a 30% discount code lifetime if you want to try 2 weeks free trial. And again, this will be on screen only. I will not put this in the description, so if you watch this far, you'll get a 30% lifetime discount of this visual stock research tool, where it's easy to see all the important metrics for different companies, thousands of companies in our database. It gets updated daily, and 14 days free trial. If you don't like it, just cancel. And yeah, thanks for watching, guys. I'll see you in the next video. Peace.